All right. So how exactly do we determine what our exit strategy is on our deals? Whether we're gonna, wholesale it, flip it, keep it as a rental, and then on the rental side, like there's obviously so many different strategies. Whether you want to like long-term Airbnb, lease to own, like how exactly do we figure out what makes sense for each deal as they come through?
Yeah, well, like starting with wholesale, right? Like that's the easiest way to just get some revenue, right? So a lot of times you're looking at it as like what's your financial and cash position? Do you have the cash to sustain a 4 to 5 month deployment on a flip or a burr? Because like those are about the same timeline, right? Like if you're going to flip a property, you're going to take it down, you're going to renovate it, same exact process as a burr. You're going to sell it or refinance, which all takes the same time. So where are you at in a financial position? Because you and I, we've wholesaled some deals that we didn't want to, but to continue the marketing machine and also to build up coffers for expected other properties we're going to be taking down. Like we've just wholesaled them. We just wholesaled one right now for a great fee that we know we can make more money flipping.
Well, I think also as well as you build out more opportunities and more marketing systems, it's easier to project where you're going to need cash, especially as you get properties that you're going to be closing on sort of down the line. And you need to make those decisions based off the immediate needs of the business. Because I think something else that is very easy to do, and we've run into this with this business, is you tie up all your money in properties, the marketing machine slows down, and then you start being like, okay, well, I'm going to pay off, I'm going to get this money back from this payoff, this flip, this burr, this refinance, whatever it is, at the end of the month. And then that date rolls around and for some reason it doesn't happen, right? And now you're completely screwed. And we're dealing with this right now, actually, on this, this condo deal where, I mean, who could have predicted this situation when we got into this project? But you want to explain that, Dan?
Yeah, so we have a condo. It's more of a side-by-side duplex, but it's set up as a condo with its own HOA. And the HOA fee is like $50 a month, which pays for the insurance. So you technically don't need to pay for insurance. So not a total bad setup, except for the condo associations had 3 claims in the last 3 years. So their insurance company they use is like, no, sorry, we're only going to give you this much insurance, which isn't enough to cover the actual value, like the replacement value of the property. And then on top of that, the HOA bylaws, whatever you call them, basically states you can't get your own insurance, which is a farce because the neighbor has its own insurance. Like, so you can, but just the way it was written back in the 70s, it says that. And so now we're trying to connect the dots, get the HOA president involved, get the insurance company involved, get the lender involved for the buyer so that we can be like, all right, guys, what do we need to do? Because like you and I are like, I will pay for anybody's insurance for the next 2 years, 3 years. I don't care. It's cheap, right? Like, just tell me what we can do to close this. Because, yeah, we're expecting in a week we should be getting a payoff, which is all of our costs and rehab costs and down payment on this thing.
Buyers are going to not like whatever decisions you make. Back when I was flipping houses like 2008, 2019, before it was just a buyer's frenzy like it is now, I'd get feedback like, the buyer doesn't like your door handles, so they're not going to buy the house. And you'd be so pissed. I'd be like, I picked those out. Like, I'm taking that personally,
Yeah. Yeah,
So like
yep.
for us,
Yep.
anything that can be a value add like that, because those things aren't that complicated and it's very easy to determine. And then besides that, I mean, if it's mostly cosmetic stuff, we like easy deals. If they're like people that are doing like large cosmetic gut jobs, not our favorite, just because it's expensive. They like you have to have a much better deal to cover that cost because you're not forcing any value appreciation. And I mean, recently, I mean, how it's been with like materials and stuff, just like having to plot all that out. Yeah.
It's hard to get. It's hard to get them. It's hard to get what you want. So if you have a systematized approach to like your build package, you might have to go search for new stuff to try to fit that.
And I would say, honestly, I would prefer to do a house that was like kind of outdated, that we just left the outdated part alone, but we were able to like finish a basement, right? And just like make the basement like good enough, rather than have to do a house that was like outdated and we're going to completely renovate the entire thing.
What also it's sometimes too, like if you look at a house and look at the square feet of it, how big is it? Because if it's above 2,000 square feet, like you start getting like 2,500 square feet, you're starting to really have to touch a lot of things. And it gets expensive when you talk about per square foot cost. And so like we've passed up on some great deals, but they're like a 3,000 square foot house because we're just like, the risk is too big of like, once you start into something, you have to keep going, right? And you're renovating this thing. You can't just renovate like one bedroom and call it good, right? You hit the kitchen, made the bathrooms, all that sort of stuff. And then all of a sudden you still got 1,000 more square feet to throw flooring on, right? So that gets really expensive. So I look at that too. Like if it's a 3-bed, 2-bath, 4-bed, 2-bath, like those are typically super good slam dunks.
You know, you can make a property so desirable to an individual that they're going to be willing to pay so much more than it's actually worth for it, you know, because it looks great, like it has all the fun features, whatever. But if an appraiser comes in and they're like, well, this property is way overvalued for the neighborhood, that can literally destroy your entire deal, you know, unless you have a situation where a buyer's willing to pay that much extra in cash out of their own pocket to cover the appraisal gap that the appraiser just made, you know. And that's even more so the case if you're looking to refinance into a rental, where literally the only thing matters is what the appraisal thinks, because there is no market opinion on it. An appraiser does not care that you have this beautiful property. They will go ahead and pick the worst properties that have sold nearby that are like the most like kind in terms of size and age and all that sort of stuff, and completely ruin your entire thing.
Yes.
Thanks for listening. Please leave us a review on iTunes or wherever you get your podcasts. And check us out at collectingkeyspodcast.com for tips and guides on starting your own real estate investment and wholesaling business.